So, as the room fills, I will introduce our panelists for us. We're having a nice little conversation here. So, we have... That's the spirit, that's the spirit. So we have Tim Dudley from Tembo Capital, who is investment director at Tembo Capital. We have in the middle Peter Rosenaz, who is a portfolio manager with Orion Mine Finance. We have Bert Koth, who's managing director and partner at Denham Capital, and Andrew Ferrier, who is an investment director at Pacific Road Capital. Jimmy Lim was supposed to be here, but unfortunately he has been held up in some unavoidable meetings. So we will crack on without him. We've got a fantastic lineup here of expertise, so you are in for a treat. So, gentlemen, we want to talk a little bit about the availability of funding for the mining industry and how we generate the best returns, generate value, growth, and nurture the next generation of mining projects. So, on the subject of availability, in the equity capital markets, how's it looking? Who'd like to kick us off? Tim?
Yeah, well, I think the equity capital markets are looking pretty mixed, actually. I think if you were to go to the TSX or London, it's not that buoyant. There's a lot of brokers there that would say they'd struggled to raise capital for traditional, say, gold companies that have been bread and butter for those two markets. I think on the ASX, if you're in the right space, it's really boom time for you if you're in potentially the electric vehicle, battery metal type space. But beyond that, I still think there's still a lot of companies that are struggling to get traction and getting investment for what look like reasonable deals. And I don't think there's a huge belief by investors and more generalist investors in the long-term commodity prices are going to stay at these kind of levels, which they've returned to. Mm.
I think early stage equity investing in mining companies is a value type investment process. And anyone that follows the stock market knows that value type investing has been out of favour for about 10 years. So, as evidenced by people like Colonial First State GAM closing down a $3 billion fund and citing lack of investor interest, I think the public side equity markets are going to remain challenging for junior mining companies, predominantly for a lack of institutional support. What that creates as an opportunity, though, is there are pools of capital who are prepared to invest in deep value, illiquid opportunities. And there's been some evidence of companies kind of generating equity type returns by providing sort of debt type products. So depends what sort of hat you wear. It could be a good thing or a bad thing. But I think that for a mining company, they just need to recognise that the pools of capital are different than they were historically, and I don't see that changing.
Why do you think Colonial First shut down their fund? I mean, they said lack of investor interest, but surely at a time when people are talking about a new sort of bull run in mining, is that the time to be shutting down a fund?
Well, I think Colonial First State GAM is being sold by the CBA, and the CBA basically got rid of not only natural resources, but they got rid of their, they call it core equity strategy, which is a hybrid value and growth strategy. Effectively, those deep value strategies haven't been able to achieve the returns that the investors expect. So the investors just pull their money and the fund manager closes it. It's pretty simple.
But what's your take?
Yeah, I mean, obviously there has been a selective recovery, but I think the emphasis lies on selective here, right? Because at the end of the day, when I look at the deals that we managed to get done as a fund, and we are at the end of the day private control investors. We target projects that are 2 years away or so from cash flow, and we have been able to acquire several of those at still relatively attractive entry valuations over the last few months. So I would argue that's an indication that for a significant number of players in the market. They're not able to raise the development capital. They're not able to raise the capital to move themselves otherwise forward. Yeah. Yes, there is a boom in battery metals. Yes, gold equities have recovered. But let's not forget there are significant other sub-segments in the metals and mining space that do not benefit from this recovery. So I would say it's a very selective recovery. And there are still significant market risks out there.
How long do you think it will be before sort of large amounts of equity capital markets funding comes back into the market? And you know,
I don't have a crystal ball, obviously, so I have my opinions, and they might be the wrong ones. But let's not forget, with the end of the super cycle, because of gross misallocation of capital to the degree of tens and tens and tens and tens of billions of dollars, yeah, so much money has been lost that, well, you might never have the same amount of capital coming back on the public markets. But who knows? But the overall capital losses have been so significant with the end of the super cycle that a lot of people got very, very badly burned. I mean, there's a number of specialized mining funds that are down 50, 60% performance-wise that will never recover. So,
do you think, though, I mean, you said, the end of the super cycle. There are people out there who believe that we are still in the super cycle in terms of, the developing world becoming middle class and building houses and wanting fridges and air conditioners and televisions. What is the panel's feeling on this? On are we in the, where are we in the super cycle? Does the super cycle still exist?
I'm not sure if super cycle is the right phrase. We're certainly entering into a period where the whole world seems to be growing in unison, which is obviously pretty beneficial for commodities. And that's what we invest in. I think just broadly investing in any mining company is going to be fraught with danger. Asset quality is going to be the most important thing from our perspective when we're looking at things. But relying on the super cycle to make your returns for the next 5 years, I think is a fairly dangerous way to play the market as we see it today.
So, anyone else have any thoughts about the super cycle?
Well, I mean, I think the right question to ask is, look, what the market is going to do tomorrow is primarily for the momentum investors, yeah? If I were a punter who kind of have a shell and then I try to trade out a bunch of shares, that's what I would be worrying about, right? But the people here on this panel are institutional investors who need to make real projects happen to have monetizable outcomes, right? So for us, the more important question is really not what the market's going to do tomorrow, day after tomorrow. The more important question for us is actually how many projects are there actually out there that actually stack up to rigorous due diligence. That's actually the much more important question. How many management teams out there that can actually genuinely deliver versus just tell a beautiful story to the market. So these are really the more important questions in our opinion.
Absolutely. Although at a presentation earlier today by Joseph Jacobelli at Bloomberg Intelligence, we're talking about power generation in China. And their predictions by 2050, they think that 40% of China's power will be generated by renewables. So, if you think about the amount of wind farms and solar panels and what have you that would, and of course grid storage that would have to be built in order for that to happen, that's an awful lot of commodities that are going to need to be deployed to make that happen.
That's true, but then I guess you look at copper, so 25% of the world's consumption's been by the China state grid, in the last sort of 15 years. So, the kind of, China's not going to build in the next 10 years what they've just built in the last 15. They're not going to replicate that rollout of the electricity grid. So, there's a demand shortfall from that. Maybe it gets offset by something else. I think sort of echoing what Bert says is, we really focus on how many projects can our bit of capital make a difference to? Is it enough to there've been a bunch of technical and commercial studies. Is our bit of capital going to be seen as a de-risking event? And is it sufficient to get this project up and running? When you're dealing with precious metals, you don't really have to worry that much about, supply and demand conditions. When you're dealing with base metals, you have to be cognizant of the fact of, product quality, smelter, which smelter, et cetera, as the world has got this obsession with electric vehicles, and you've got mining companies who are now producing industrial metals where quality tolerances are zero from the off-takers. We're in a new and exciting phase, but also an equally dangerous phase, because mining is more of an art form than it is a science, and industrial metals is a science.
You've brought up an interesting point there, actually, about traditionally, well, not traditionally, but when you ask investors about, in the past, when you've asked investors about whether they are interested in investing in a project which involves a new processing technique or something like that, they traditionally have shied away from that and said, no, I want something simple. I want like heap leach, open pit, simple projects. Is there going to have to be a real shift in the mindset of investors to sort of learn more about the processing techniques and like you say, these mines where they're producing a commodity which needs to be tested by the end user for several years before it can be
Look, I think the investable universe in nickel cobalt projects is tiny, probably tiny, versus the universe of promoters. The number of successful build, commissions, operates in the nickel cobalt space. I mean, we all know what the projects are. We all know how long they took to get up and running. And we all know how many projects are looking for capital right now. I mean, if you have, I guess, a bunch of grey hair, you kind of remember how bad it could have been. Does that prejudice the ability of the current projects to deliver on time and on budget? I guess theoretically no, but it's going to be a serious challenge. There'll probably be a couple of $1 billion worth of capital destroyed during the process. Not every one of these projects is going to get up and running, so you've got to be very careful about selecting the right ones and who's to back. Just simply because you have a car company saying, I'm going to build, 10,000 EVs, doesn't mean that a mine that's producing a spodumene concentrate is going to, get its funding and get up and running and return funds to the shareholder. So I think you really need to look at the entire value chain and the technology, the value chains that it's going to displace, the impacts that EVs have on all value chains, not just basic materials, to decide where you want to deploy your capital.
I think on top of that, just going back to something Bert was saying, is that we try and invest in not only companies that we and areas that we know well, but we also invest in management, and we look for management that's got a background in delivering projects of that nature. And so if you're going into a brand new area or advancing a new technology, and if that management team's got no background in that space, then it's very hard for this type of capital to invest in that area.
I fully agree with Peter actually said before that, I mean, the more complicated a project gets, the more downstream processing is, the higher the execution risk, right? And the significant majority of mining projects, when they actually developed in production and ramp up, things do not go according to plan, right? When you add significant downstream processing to it, like it's the case in some of the battery metals plays, right? You actually magnify the execution risk very, very significantly. And I would argue most mining investors and most mining investment funds, frankly speaking, are not well equipped to actually invest in downstream processing. There's very, very few management teams out there who can genuinely actually handle that.
So given your thoughts about the investability of a lot of these projects, do you think, given the demand that is likely to be there for battery materials going forwards, do you think that there is going to be sufficient new product coming on stream to meet the demand?
Who knows?
I don't know. I mean, there are some metal. Look, it seems like every sort of project in the world's producing spodumene concentrate at the moment. Look, there are the only metals where where it seems there is an enormous supply-demand imbalance are very small, niche sort of markets. The overall more commoditized metals, including cobalt, I think are pretty well sorted out from a supply standpoint. If you're talking about, some of the markets like vanadium, where there's very little, there's only one or two pure vanadium mines in the world, and the price has absolutely gone skyrocketing in the last 12 months. That there's an opportunity, but vanadium doesn't occur in a sort of mineralogical form as something easy that you can get out. I mean, you basically need to build a chemistry set to be able to extract vanadium. I think the overall supply and demand dynamics are pretty well forecast and published in deck prices, which is kind of $3 copper, $1.10 zinc, $1 lead, et cetera,
I mean, the reason for my question is that, people always say, oh, well, there's all these new lithium projects out there about to come on stream, about to be developed. And they seem to make an assumption that all these projects are going to get funding, where on the other side, you guys are all saying, these projects are sort of, not as investable on the development end that you might think. I mean, people are willing to make a punt on a share price going up, but whether they're actually willing to deploy significant capital that is required to build the mine and to build the processing.
So if you look at, I think what you need to be aware of, say, let's just think about nickel for a moment. So there's a lot of excitement about producing nickel in a particular manner that the cathode manufacturers love it, which is interesting. What is the supplier response going to be from the nickel refiners? So, Nickel West, I think it was in September of last year, made an announcement for, a small amount of money, 45 million US or something, that they were going to be able to put a process on the end of their plant in Kwinana or Kalgoorlie or wherever it is, to be making a product that's suitable for the cathode manufacturers. The guys looking to build the projects are looking for $1 billion to build their assets. So, there's a supply side response from people who are already in the value chain. So I think you can't assume that a particular type of technology is going to be a dominant technology that's going to last over the course of a lifetime. The life cycle of some of these battery products may be very, very short. And if you have sunk billions of dollars of capital into the ground to generate a product that's got a short life cycle, that's not a good investment. So I think, again, you just got to be very careful as an investor about where you put your cash.
Sorry, and I think the companies that are getting funded or will get funded in this space are more likely to be seen to have strategic investors come in. Someone who's a downstream consumer or something, reaches down and brings these things into production, and that's why you'll see successful companies in the space. But it's not necessarily, mining private equity investors that are doing that.
Absolutely. I mean, are we going to see more of the non-traditional investors, mining investors, coming into the space? For example, in some of the battery materials companies, you're seeing investments from the very end users, the car companies, the battery makers, and sometimes some of the tech funds.
Yeah, I think that's right. I think the end users at the end of the day are going to be the ones that fund it. Security supply is obviously a big risk for them. From our perspective, we don't really critique the demand side of all these sort of, clean tech commodities. Where we really struggle is on the supply side. So your question before, is there going to be enough supply? We think it's going to be pretty oversupplied in a sort of, fairly quick manner. A lot of projects are out there. There's no real shortage of any of those commodities. And our analysis on the supply side is just, you just don't know what it's going to be. So you change a few variables only slightly and you can get absolutely swamped. So over a 10-year investment horizon, you just don't know where that commodity is going to be in 5-7 years. Demand side, you can have a fairly good guess over the next 10 years. Supply side, I'm not too sure.
All these forecasts that always kind of point this really steep hockey stick upwards, they all have one in common. They usually don't happen in reality, ultimately. So, I mean, I've lost track of all the optimistic forecasts that did not materialize at the end of the day. So if people come to office and all show us these beautiful charts like whatever, we'll have that many electric vehicles and it's going to blow the world copper supply balance, everything out of demand. God, I've seen so many hockey stick forecasts before that evaporated into thin air. You can't base any investment decisions on that.
Let's talk a little bit about your investment approaches from your companies. If you can tell us, how much, the state of your various funds you've got at the moment, and the type of projects you invest in, and your hands-on or hands-off approach. Tim, do you want to start us off?
Yeah, the Tembo Mining Fund has about $250 million of allocated capital across 2 funds. We're an emerging market in our focus, with a particular focus on African investments. We invest across the kind of the development to production stages of mining companies, and we deploy we look to deploy about over time, $20 to $30 million US into any particular investment. We have got a large amount of that money deployed at this point in time, and looking for more global opportunities now to go into our next fund.
And when you're talking to your LPs, what is the appetite for mining investment at the moment? Are they, my question goes back to sort of the equity capital markets kind of end of things as well. Are they looking more favourably at PE at the moment?
Well, my experience is that the type of LPs that invest in this space are very long-term in their outlook and are counter-cyclical. So they do like deploying and seeing capital deployed at points in time in the cycle where they see that the others are not investing. So they are very interested in this space at this point in time.
Fantastic. Peter?
So I work for Orion. We manage about $4.5 billion US, and we provide late development stage financing, essentially to base and precious metal opportunities. So basically PFS and later. We like to invest across the capital structure so that our capital can be, provide the bulk of the funding that the company needs, leaving it a kind of small equity cap. We like to be hands-off and just let people get on with and execute their business model. Most of the time that works, sometimes it doesn't. We've had a bit of style drift, I guess, in the last few years, when we've put a stream into a lithium project, just got announced a few days ago, and a diamond project in Quebec. So, look, our investors are the traditional pension funds out of the US, and they want long-term, they do take a long-term view, but I would say the appetite's pretty good for this style of investing that we do.
And why do you think they prefer to put it into a debt fund rather than giving it to, JP Morgan or a regular equities fund?
So the bucket of money that we get our funding from is called the real asset bucket of money. So if you're a pension fund and you manage $100, you have various buckets of money. You have an inflation bucket and a real asset bucket, and you might have forestry in there, and some of the energy products and agriculture, etc. And they just have space within their buckets for our mining fund. I mean, effectively, we sell it on the basis of you get equity-like returns with a secured position in the capital structure. So as they run a manager selection, we may be competing against a forestry fund and a energy fund in our particular, for the next $100 million as an example. And they just decide to choose us because, for whatever reason.
Usually good.
Well,
But
yeah, so I represent Denham Capital. It's a US private equity firm. In metals and mining, we have to date invested approximately $2 billion US. We execute what's called a back management team strategy. That's commonplace in oil and gas private equity. It's unusual in mining. Our typical approach is we take management before they have the projects on a blank sheet of paper to go out and take control of projects that fit their prior execution success. And then we develop the projects into production, sell them. Sometimes we buy already a small-scale producing mines, and key value creation is expansion of production. So it's also late stage. We do not engage early stage in exploration or early stage de-risking, because when you're early stage on the curve, you only make money in an up market. In a down market or in a more sober market, nobody's going to pay you for exploration success. People pay you for producing assets. How LPs think about us? Well, obviously there's a critical mass of LPs out there who like mining managers. Otherwise, I mean, most of us here on this panel have recently gone through successful fundraisers and closed those. Your question, why do they give money to one fund and not to the other fund? There is, in my opinion, at least a very careful differentiation underway at the moment, which fund managers are recipient of capital, because there have also been a number of funds that have performance issues over the last few years. I would say it really boils down to track record and strategy at the moment, and the capital deployment profile and the visibility thereof, who gets the money and who doesn't get the money. I also think the next 2-3 years we'll see a further shakeout in the metals and mining specialized fund manager space.
So, I mean, the fact that, you know, Colonial First are shutting down their fund because of lack of investor interest at the same time that you guys are all successfully raising new money for funds, is that part of a general shift from, you know, mutual funds to private equity, or is it just that one case?
I think they're not the only sort of fund manager who are sort of closing down natural resources. I think a lot of the look, there's a lot of fee compression in when you're running a generic sort of just beta strategy in natural resources as a stock picker. So it's not a very profitable business for the fund managers. Most of the investors are retail investors. I had one company telling me today that on the TSX the hottest commodities to get into are cannabis and Bitcoin, or cannabis in Bitcoin, or the other way around, or whatever. So a lot of the risk capital is going into other areas. From a retail perspective. So from the private equity point of view, our pension funds have a 10-year outlook. Retail investors have a 10-minute outlook. They're completely different buckets of money. Unfortunately, I guess in the last 10, 20 years or so, at certain points of the cycle, the retail investors have provided a lot of the risk capital for junior mining companies. And they're kind of addicted to that form of funding. And I just don't think it's there as broadly as it was before. For certain projects, sure, but not for all.
Andrew.
So I work for Pacific Road Capital, which is an Australian-based private equity mining fund, manage $800 million over 2 funds. We're a later stage focused fund, sort of look to provide sort of construction equity, which has been the key focus in Fund 2. Strong technical focus on all the investments we're in. We're a pretty hands-on approach as well after we've made the investment. 3 to 5 year time horizon on each investment we make. And just, I guess, board seat at a minimum, but mostly focused on helping the companies in terms of technical help or financial help, wherever we can add value along the way. And I guess what LPs are looking for these days, I think they're looking for investments which are closer to cash flows. I don't think they're interested in investing in a PFS project which has 6 years and a permitting time frame in front of it. I think they've just worn out with that sort of investment style. So if you can provide that with some structuring, if you can provide a near-term cash flow investment opportunity with some structure in what you're doing as well to protect you on the downside, also providing some upside, I think that's what excites them. I think in general they're pretty interested in getting into mining because of that theme you were speaking about before. But yeah, we've got to be able to generate alpha over the general market.
And do you invest across the full range of commodities, fairly commodity agnostic, or do you favour one over the other?
Yeah, we can invest in anything. We're largely focused on, hard coking coal, base metals, and gold. So we keep it fairly simple like that. We have invested in a wide range of things. We're in diamonds and mineral sands and all that good stuff. But going forward, I think that's where we see, the most bang for our buck going forward.
So who's investing in the exploration then these days?
Other mining companies. Miners will invest in miners.
We're happy to invest in exploration, provided that there is already a geological model and there's an intention, or there's a good understanding of what we're drilling, and we're largely just drilling out a resource. So, more like infill drilling than grassroots drilling. But that's a very odd case, and it requires, very, large confidence in the management team and the geological understanding of what we're investing in. We're fortunate that we have a number of guys in Tembo that have got a good exploration and geological background to make those judgments. But we much prefer being closer to production, like all others, in terms of trying to generate a return and a more confident return.
I mean, we typically, when we've brought some of our mining projects into production, we usually use some of that cash flow to try to unlock additional upside in the asset with further exploration to basically expand the resource, unlock additional life of mine, those types of things. But that's obviously not kind of greenfield exploration, early startup, so we certainly don't do that. There might be the odd company that attracts a few $1 million from the market to do that. But, at the end of the day, and we've seen this also in our own portfolio, in exploration outcomes, you can only monetize making money when you have a strong upmarket momentum, right? When basically almost everything makes money. If you don't have a very strong upwards momentum, nobody's going to pay you for exploration outcomes. And as private equity managers, we receive the money that we can make money in any market environment, irrespective of what the public markets are doing, right? So therefore, we cannot underwrite any strategies that only make money in an up market. So therefore, the entrepreneurial drill holes greenfield is not an asset class for private equity to try to make money. We once carried out quite an interesting study with one of the large mineral economics houses, actually what over 25 years the equity return on exploration is, and the answer is actually 0.
That being said, some of the more successful companies listed have performed well because they've expanded their valuation fast through drilling and identifying projects. Then they've diluted their capital base. So there is examples where there has been good returns made by companies by using the drill bit, but it's not a strategy for everyone.
Let's talk a little bit about capital discipline and where we are in the cycle, and whether what you'd like to see companies doing with their cash, particularly on the producing companies, obviously generating cash at the moment. Still fairly conservative, it seems, from wary about what happened at the end of the last cycle, where a lot of the bigger companies, their CEOs made some what were judged to be ill-advised mergers and acquisitions and lost their jobs. What would you like to see companies doing? Is it time to see the companies start to go out there and be buying more stuff and developing more projects?
It's an interesting question. I was at an equity conference a couple of weeks ago, and the mantra had changed from what it was 2 years ago. So this is a global equity conference. 2 years ago, the mantra from the shareholders to the mining companies was conserve your capital, don't do anything stupid, capital discipline. The mantra this year was, why aren't you producing more? There's a healthy margin in being a gold producer. Why aren't you producing more gold? So I think if you're a mining company and you listen to your shareholders, the story will change month by month as to what they're looking for. So you kind of got to ignore that noise, even though they're very important stakeholders. So just ignore it. Take your project and apply best engineering practices, and don't try to game the funding system. That's our recommendation. So don't try to skimp on work. Don't try to shortcut things. Accelerated DFS. Oh, we're not going to do a PFS. We're just going to go straight to DFS. We're going to build on a scoping study. All that kind of behaviour is really poor practice. So we like companies. We invest in companies when we have intellectually honest discussions about the right development milestones to undertake in order to get the capital allocated. And they're very commonly that generally involves a lot more technical work than the companies think is required. But it's the hurdle that needs to be met and satisfied.
Do you see your approach changing throughout as the cycle develops? Are you taking the same approach that you did at the bottom of the cycle that you're taking now in terms of sort of capital discipline, or are you feeling yourselves loosening the purse strings a little bit?
No, I don't think our due diligence approach has changed at all, really. I think the size of the projects can change depending on whether you've got a smaller amount of capital or a larger amount of capital. Look, there still are big pieces of larger projects tend to have better engineering and better geology and better management teams. I mean, that's just kind of the way it is, but you can't always invest in large projects. I think you've got to, there are various risk sharing arrangements that are coming together by firms like everyone on this floor are sort of working cooperatively with other private equity groups to solve an equity issue. We work closely with other private equity funds. We work closely with the banks as they can provide capital, low-cost capital in the form of project finance when a project is kind of de-risked. So there's a lot of, I think there are a lot of great achievements that the industry has been able to make over the last few years in piecing together different bits of capital to solve the funding type issue. But from the mining company's point of view, the most important thing is to do the work properly, to do the studies properly.
Yeah, for our fund, a number of years ago, probably 4 or 5 years ago, we wouldn't, with the commodity prices still pulling back, we wouldn't have looked at, say, restructuring opportunities, given that our limitation at the end of the day is the amount of capital we have to deploy. And it's hard to see where the bottom is in some of those opportunities. Whereas more recently, we have done a number of restructurings or participated in a number of restructurings, which we've had more confidence in the underlying commodity prices to participate in those types of opportunities.
Bert, what's your take on capital discipline?
No, I agree. Look, I agree with Peter. Developing a mining project is an activity where you're usually always hit by some unexpected surprises, right? Delays or overruns. It just comes with the territory because it's a very multifaceted risk profile, right? So therefore, I think you got to upfront really do all your homework properly to minimize the risk as much as possible. I've not more to add to that, actually.
And Andrew, any thoughts for you?
I was only going to say, look, our due diligence process will never change. In fact, when the market gets frothy, I think it actually has to be ramped up because the projects that have been shown to us are taking shortcuts, as Peter mentioned, and that, we're very rigid on scoping study, PFS, feasibility study. If you miss one of those steps, you basically, we can't invest in you, basically. So due diligence is a non-negotiable in terms of the standards set there, and probably only increase when the market gets hotter.
Do you have any questions from the audience to our panel? Anything you'd like to ask them? We've got some great expertise up here, so stick your hand up if you'd like to ask them anything. If not, I'd like our panelists to tell us over the next year what is getting you most excited about the industry, and what do you fear the most about how the year is going to unfold, or the next year is going to unfold? What gets you most excited? Tim?
Christmas.
Yeah, holidays, generally. I'm not. It's pretty hard to say. I listened to the panel yesterday morning, and there was a lot of talk about a market-wide crash. I'm not looking forward to that too much, but I think that I'm really interested to see how, particularly the commodity cycle plays out, particularly amongst some of the the more areas of bigger focus like copper and steel, particularly on the back of the China story and synchronized world growth. They're the things that I'm interested in the sector on a kind of macro sense, and but whether that really impacts what we do on a day-to-day at the moment, it's not something that we really spend too much time thinking about.
Given that you're reasonably well cashed up, and I think the thesis yesterday was that the market, a general equities market crash would drag down mining equities prices temporarily because the overall thematic is that we're on this, general uptrend in terms of commodity prices and demand. Wouldn't that create a perfect opportunity for you to buy some assets?
Yeah, certainly it would, and it wouldn't worry us too much about our existing investments, given that we take a long-term approach to our investments and we're here to invest through the cycle. But it obviously does. Like the sentiment yesterday was also that we'd rather have that happen now and get it out of the way, and then start working on those opportunities rather than to do a deal with a particular company and then have the crash. So, we're certainly mindful of that at this point in time. But it would create opportunities, and hopefully we've got the funds to deploy at that point in time.
Absolutely, Peter.
I'll start with what keeps me awake at night, which is the changing political landscape in a lot of countries. You've seen a lot of negative behaviour coming out of places like Tanzania. A number of jurisdictions in Latin America remain uninvestable, as does the some spots in Africa. When you're sinking a bunch of money into the ground, and the fiscal environment changes or the political environment changes, you're just shit out of luck, and so that's what keeps you awake at night. In terms of, what are the upsides? Look, I just think, we're in a really nice position at the moment, being able to deploy large amounts of capital, and that's, long may that continue. So, we're not sort of reliant upon any other macro event taking place, but the politicians need to calm down, I think, that's our fear. Our fear is they don't.
Are you invested in several sort of jurisdictions where, things could change?
No, look, we're invested in, we've got some, just in terms of, pure number of dollars, significant investments in Ecuador. We to fund Lundin Gold's Fruta del Norte project. That's kind of stable. At a helicopter level, that's kind of stable. When you're on the ground, it might be a little bit different. But we did that before the presidential election last year. That's kind of okay. We're in Namibia, Guinea, Armenia. Armenia's got a bit of a political crisis happening as we speak. Is that going to affect Lydian's ability to finish the mine? Probably not. But you just got to be aware of these things. So specifically, there are a number of countries where you just avoid because the fiscal regimes are just too volatile.
And what are you optimistic about?
Christmas is only 8 months away. A few days off.
Fair enough. Bert.
Okay, I'll look forward to bringing some of the projects in our portfolio into production this year, and let's say in the next 12 to 16 months. Looking forward to sell 2 companies in our portfolio. Look forward to close some of the great deals that we are pursuing at the moment. That's what I'm excited about. What keeps me awake at night? Look, in this business, you get very thick-skinned over time, so there's actually nothing that really keeps me awake at night anymore from a business perspective. But what are the things that, let's say, worry me or that I kind of very closely watch? Yeah, rising or resource nationalism, which is completely unrealistic in terms of its economic expectation versus what assets and projects can deliver. Plus the fact that some monetary economic policies in the US might actually lead to a depreciating US dollar versus commodity currencies like the Australian dollar, Canadian dollar, Chilean peso, because that actually wipes off a significant amount of the economics. Because previously you always said when the commodity prices fall and the underlying operating currencies like the Chilean peso, Australian dollar, Canadian dollar linked to the commodity basket ultimately, and therefore there's an intrinsic hedge against falling commodity prices because the revenue line is in US dollar. But now you have a situation with the US in order to try to close the kind of trade deficit. They would in reality, they might like a much lower US dollar. You might actually look towards a macroeconomic paradigm where actually the US dollar devalues versus a number of commodity currencies. And that puts quite some economic squeeze on quite a number of mining projects. It's actually a problem that's not widely debated, but we certainly ran scenarios on quite a number of projects, and it's actually a very, very material impact.
Andrew?
I guess what I look forward to is I guess it's a pretty exciting time for a lot of our portfolio companies. So I hope, glad to see that come to fruition and show up in the share price. But I think there will be, well, hopefully a return of M&A this year. A lot of the, balance sheets of the mid-tiers and the majors are, they're poised for M&A. People will stop asking them for dividends and start saying, why aren't you growing? So, it takes the first one to step off the ledge, and then they'll all follow pretty quickly on that. It's not the end of the world to make a takeover. But, no one wants for the first one to really go. So I think that will be beneficial for the industry. What scares me is, mining's one of those industries where you can wake up one morning and read your emails and just, you can get the most unexpected risk and pop up out of nowhere. So there's always those sort of black swan events that keep you on your toes and prepare for the worst. But, any crisis in the broader markets or in our investee companies is always just an opportunity. If you've got dry powder, you can obviously make sure the company can get through that tough period and take it to the other side, hopefully in a better position. So, downside is always an opportunity.
From the sounds of things, I mean, it sounds like, you've all got money to deploy. You're all developing your projects. Your companies are developing. There's opportunities maybe for M&A going forward. There's demand side opportunities out there. And the things you all seem to fear are things that you really sort of, they might happen, black swan events, can't really do much about it. So would it be true to say that it's a, fairly positive outlook for the sector?
It's a positive outlook if you have money to invest, because you can be selective about where you're investing. That's so. Look, I don't think there's any shortage of opportunity for anyone sitting on the floor here. So from that point of view, it's
fantastic. And I think that's probably a good place to end it. We have beers outside, so please join the panelists for those, and you can ask them any questions that you might have. But can I have a round of applause for our final panel of the day? Thanks. And that brings the conference to an end. So beers outside, and our next event is next week. If you're interested in oil and gas, back here at the Grand Hyatt next Wednesday. If not, we will see you in London in May, maybe.